Comme c'est non seulement c'est à voir.
Welcome. My name is Cameron Moultrie, founder of OptionPulse.com. Today, I'm going to be providing you with a summarization of options trading essentials. These are the things you're going to want to know before getting involved in the stock market. Did you know that analysts have a variety of techniques they use to predict the future movement of stock with a certain degree of accuracy? Did you know that you could learn these techniques and use them to trade independently in a short amount of time? No? Well, listen up. In order to make money buying and selling stock, you have to be buying and selling a lot, which could get really expensive to do. For instance, buying and selling 100 shares of Google at a time. January 22nd, 2010, Google had a low of $534 and a high of $570. That's a range of $36. 100 shares of Google at the day's low would have cost you $53,400. That $53,400 increased to $57,000, leaving you with a profit of $3,600. Not bad for a day's trade, huh? As you take a moment to look over the next couple of examples, think about what it will be like to do this on a daily basis. The one question that comes to mind for most people is, well, when's the last time I had $50,000 or more laying around? If you don't, you are not alone. These are the same examples used earlier, except this time options were used instead of purchasing a truckload of stock. In the first example, one contract could have earned you as much as $2,675 while risking only $725, as opposed to the $50,000 or more you would have needed to actually purchase the stock. This table shows the profit-loss breakdown for the purchase of 4 BIDU call contracts. A call contract increases in value as the underlying stock increases in value. More on that a little later. This table shows the current value of the stock at $132.57. If you purchased 4 of these contracts, it would have cost you $580. If the stock, BIDU, goes up in value $8, you will profit $1,716.40. If the stock falls in the same manner, your maximum risk, $580. This is the profit-loss breakdown for the purchase of 4 BIDU put contracts. Put contracts increase as the underlying stock decreases in value. When was the last time you had $500 to $1,000 to invest? When you buy a share of stock, you pay full price. You benefit only when your new shares increase in value, and you can only benefit if you own the stock. With options, you pay pennies on the dollar. You benefit when the shares increase or decrease in value. With options, you can benefit from the movement of stock you don't even own. Options contracts come in sets of 100. So if you purchase one contract, you stand to gain as much as an investor who purchased 100 shares of a stock. Options were actually created to reduce risk in the stock market. Have you ever collected on a car insurance policy? If you have, then you understand that if you get into an accident, your policy will increase in value to wipe out any losses that may have occurred from the accident. In this case, remove the word car and in its place add the word stock. This guy didn't even own the car. Here's how it works. When you buy a call contract, you're actually buying the right to purchase 100 shares of a stock at a set price by a set time. If you purchase your call contract where the green line is, then allow the stock to increase by a few dollars, you can sell your contract for a new higher price where the red line is. Or you can exercise your contract, which means you plan on purchasing 100 shares of a stock at the price it was before it went up in value. This is a put contract. It is the call contract's exact opposite. You purchase a put contract when you think a stock is going to decrease in value. If you buy your contract where the green line is, then allow the stock to fall by a few dollars, you can sell it for a new higher price. Or you can exercise your contract, which means you plan on selling 100 shares of a stock at the price it was before it went down in value. All contracts expire on the third Friday of their designated month. They lose value incrementally until expiration. Analysts, while evaluating stock, are constantly watching for two significant points on a chart. One is called support, shown in green. The other is called resistance, shown in red. The support level is the point in which heavy buying is likely to occur because the price is cheaper and bargains are found here. As the buying increases, it drives the value of the stock up. As the stock continues to increase, it begins to look less and less like a bargain. In fact, it begins looking too expensive. This is where resistance is found. Heavy selling begins, bringing the value of the stock back down. This is the basis of all technical charting. Learn it, master it, and soon you will be able to reach the same conclusions the analysts come to. We'll not only show you where to get the tools you'll need, we'll also show you how to use them. Through the use of these two simple contracts and basic charting techniques, we can teach you to find profits in any market. Our accelerated charting and options course will give you the insight to make trades based on the same information the pros use. Not ready to invest in a $4,000 trading course? Our options trading course starts at only $250. You'll receive our Rhythm of the Market Options Trading Handbook, a virtual guide assisting with the opening of your practice account, and 2 one-hour live coaching sessions with one of our experienced traders or brokers. Truly everything you'll need to get started when you are ready. For more information or to order your option box, please visit www.optionpulse.com.